In 1796, the first estate tax was brought into the UK after the French Revolution.
The idea was to interrupt inherited wealth. In 1975, the capital transfer tax was introduced.
Followed by inheritance tax in 1986.
Today, you can leave behind up to £325,000 tax-free, plus an additional residential allowance, which is set to be £175,000 by 2020, provided you qualify. There's also no inheritance tax between UK husband and wife, and you can pass your allowance on to your surviving spouse after your days. All of this means that you could leave behind up to £1 million of assets to your children, provided your property is worth the residential property allowance and your total estate doesn't exceed £2 million.
Everything over your allowance is taxed at 40%. This can be a real problem if you inherit assets that are not quickly accessible.
Tonight, we're enjoying a bonfire and some fireworks. So, what better time to talk about inheritance tax? After all, it can hardly be rocket science.
Dad! When it comes to inheritance tax, there are a few exemptions you can make to stop the taxman spoiling your party.
For instance, if you have a working farm or a business that you're passing on, you may qualify for agricultural or business property relief, but make sure you've personally checked out your situation with a qualified and competent tax and trust lawyer or accountant.
You can also make a will to charity, which could go to a good cause and also save you some tax.
Furthermore, there are investments you could make which would reduce your inheritance tax bill, such as investing in the alternative investment market. But make sure you've sought professional financial planning before racing down that route. When it comes to inheritance tax, the simplest thing to do is to give assets away to reduce your potential inheritance tax bill. But can you afford to do this, and are there some rules to consider?
You can give up to £3,000 per tax year under your annual gift exemption. Thank you.
Also, if you've forgotten to use a tax year's allowance, you can carry back 1 year and double up your allowance, meaning that for 1 year you can give £6,000, and for a husband and wife that would actually be £12,000. You're doing quite well there, aren't you? There are other exemptions you could consider, such as gifts upon marriage or the small gift exemption. It's well worth looking these gifts up to make the best of your inheritance tax allowance.
You can also make gifts out of your income.
But you need to make sure that you can prove you're not selling yourself short and affecting your standard of living. And furthermore, you need to make sure that you can demonstrate you're not really giving capital away. The most commonly considered gift is a pet.
What, give away your dog?
No, the potentially exempt transfer. This is a larger gift that is potentially exempt from tax. To get the most from a pet, you need to survive for 7 full years from the point of giving the gift. So it's very important to make your gift before time runs out.
But you don't want to leave yourself short.
No, this is where good financial planning comes in, so that you can make sure you can afford to make the gift and take advice to make sure that you don't retain some kind of benefit, and that therefore you're not making a gift with reservation which would fail in the eyes of the taxman. Hang on a second. You might not be ready to pass on assets to your loved ones all in one go. It might just not be safe to do so, or you might be concerned that actually someone may take advantage of them. This is where having a trust is a really good idea, so that you can protect the assets.
So I don't get any fireworks until the party's over?
Well, no. The idea of a trust is a little bit like this box full of fireworks. As a trustee, I can't use the assets myself, but I can distribute assets gradually to the beneficiaries while safely keeping control of the assets that are within the box.
So, can I have the whole box?
Well, that would be down to the trustees. Ideally, you want the trustees to be of the same mind as the person who's made the gift. Trusts still do carry some costs in terms of setting up and ongoing, and also there are some tax considerations. So trusts won't be right for everyone, but in certain instances they're a really good idea and well worth discussing with a competent tax and trust lawyer.
So here's our 5 top tips for inheritance tax.
Make sure that you log all your gifts carefully somewhere where your executors can find them so that there will be no confusion later on.
Give away gifts whilst you're young enough.
But make sure you seek professional financial planning to be sure that you can afford to give those gifts. Don't let the tax tail wag the financial planning dog.
See a solicitor so you can make a will to make your wishes be followed.
Remember that the tax rules are forever changing, so stay in touch with us to find out more. You know, at Thomas & Thomas, we're always looking for innovative and fun ways to present our financial plans and ideas. If you've enjoyed this short video, please feel free to pass it on to someone that you believe will benefit from it. And if you want to discuss inheritance tax further, we'd be delighted to help.
Come on, Dad, the fireworks display is about to start.
Fantastic. In 1975, the capital tax...
You always mess it up.
That's really hard of it. Sorry. We'll get it right now. Take 2.